So joining us now is the author of that note, Alex Saunders. He is Citi's head of quant macro research. It's great to have you on, Alex. And let's start right there. What is the bull case for crypto?
Yeah, I mean, quite simply, the bull case is based on flows. We've seen a huge amount of flows in the last year, and we continue to expect those flows to be realized. So flows into year end and then flows for the next 12 months. That is really the key determinant of the bull case, but even the base case for both Bitcoin and Ethereum.
Where are those flows coming from?
The ETF is the best proxy, the best high-frequency proxy to measure those flows, and that's where you see pretty consistent inflows. Now, recently we've seen a pickup in flows from digital asset treasuries. Those ones potentially are not as consistent, and it depends on how far above their NAVs the stock is trading, and so we see those premiums, if you will, decline, but they're still above one, so it still makes sense for them to be buyers as well. But primarily we see the ETF flows as being the catalysts.
Okay, whether it's Bitcoin or whether it's Ether, how correlated are the moves higher in those two assets to things like the dollar or gold?
Yeah. I mean, I would say one interesting thing for Bitcoin in particular is that correlation with gold has picked up. Bitcoin is often thought of as digital gold because of its limited supply. The big difference with analog gold, if you will, is the equity beta, which doesn't provide, in my view, as much of a portfolio hedge. But we have seen a pickup in the correlations. But I will say that the primary determinant on the macro side for Bitcoin and Ethereum, where they have similar exposures, is equity markets still, is kind of risk appetite.
So I'm looking at these 12-month forecasts. Bitcoin, $181,000. Ether, $5,400. What are the biggest risks?
The biggest risks, in our view, to that case is not actually from the flows, particularly for Bitcoin. We think they are likely to be fairly persistent because we are sort of fairly early in the adoption cycle of financial advisors and asset managers. So those are likely to maintain. The biggest risk is a change in sentiment from the macroeconomy, and in particular, downside to equity risk, because we think that would, number one, probably reduce the amount of flows that you see, but secondly, because of those exposures and because Bitcoin and Ethereum are quite sentiment driven, would drive that price down.